Well, good afternoon. Happy Friday, July 25th. Mark Milam here, your mortgage professional. A pretty quiet week, not a lot happening, and mortgage rates are tending to trade now in a very narrow band, somewhere between that 6.5 to 6 and 7/8 range. And we haven't been able to break out of it. We're going on about 4 or 5 weeks in a row. Really, the last great opportunity we had came right before the July 4th holiday. That was Jobs Week, and we were poised to move to the best rates of the year. And unfortunately, the jobs data that came out was just too hot for the bond market, and we saw mortgage-backed securities sell off and mortgage interest rates headed higher as a result. Well, fast forward 30 days later, and we stand poised to move into jobs week next week. Boy, next week's a busy week. Not only do we have the jobs week, which is probably the most impactful economic reporting that we get for mortgage interest rates, but we also have the Fed meeting, the two-day Fed meeting with the policy statement coming 2 p.m. Eastern Time on Wednesday, July the 30th. It's not anticipated at all that the Federal Reserve is going to alter the Fed funds rate, but what will be interesting is how the votes play out and what the policy statement is at 2:30. We've started to see some dissension in the ranks of the Federal Reserve, some voting members and non-voting members expressing a desire or an interest or a speculation to go ahead and begin cutting the Fed funds rate, even as inflation starts to tick up, as we've seen in the most recent consumer price index, inflation ticking up to 2.7%. Of course, the Fed's target is 2%. Let's take a quick look at a little bit of the data. The NAR put out the total existing home sales for the most recent 30 days. We're getting that annualized pace now down below 4 million, and that is steep recession territory for existing home sales. We don't like that. We don't need to be below 4 million. That's certainly not boding well for the resale market, and existing or new home sales are down about 6.7% year over year. Just still an affordability issue. Home prices too high, interest rates too high, squeezing out a lot of first-time home buyers and move-up buyers as well. If we take a quick look here at one other thing that's going to be happening, this is a little technical, but it's the Treasury quarterly refunding process. Now, this is going to happen on July 30th as well. And this is where the Treasury comes out and says, hey, this is how we're going to fund the federal government for the next quarter. When we don't have enough tax revenue, of course, we have to auction off treasuries. And one thing that's been on the heart and mind of the Treasury Secretary is that we really don't want to be auctioning off long-term debt, 10-year to 30-year treasuries, because it puts upward pressure on long-term interest rates, including mortgages. So expect that refunding announcement to include some language about shorter-term instruments. These are more like notes that are going to be auctioned off that are shorter in duration, that won't put upward pressure on the long end of the yield curve. That would be very welcome news for all of us in the mortgage industry or in the housing sector, as we need affordability to improve. But keep your powder dry as we head into next week, because we're going to get a lot of economic data around job openings, around non-farm payroll creation, around unemployment rate. We'll have the Fed meeting on Wednesday with the policy statement coming out 30 minutes after the meeting. And of course, the Treasury refunding announcement as well. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at Highland MTG. Have a good weekend.